All right, so I made my first mistake with covered calls, which is choosing a strike price that I'm comfortable selling at. So basically, I had 100 shares of Ford in my RSP account that I bought at $10.95. And of course, Ford dropped all the way down to $7 and $8. Ford pays a dividend of about 7% per year, but of course, I wanted to generate more income from that investment. So I want to sell covered calls every month on my investment so that it doesn't feel like dead money, although it's not dead money because I'm still getting dividends, but I guess I was greedy. I wanted to collect more out of it. So I want to sell covered calls. So as you can see here on this line here, I sold covered calls expiring January 11th at an $8.50 strike price. And I collected $40 out of it. So $40 minus fees is $29 divided by my investment in Ford, which was about $1,100. So 29 divided by 1,100. So collected 2% in 1 month. And if I was able to do that every month, that's about 31% a year. So that's why I was greedy, and that's why I was going for that. Now, I bought the shares initially at $10.95. So by choosing a strike price of $8.50, that means that come expiry date of January 11, if the market price of Ford is trading above the strike price that I chose of $8.50, even if it's trading above $8.50 by a penny, so if it closes on January 11th, which was yesterday, if it closes on January 11th at $8.51, I will lose my shares. I will have to sell my shares at $8.50. But since I bought the shares at $10.95, I didn't want that to happen, of course, because I'd be losing more than $2 per share. So what I had to do, as you can see on this line here, I had to buy it back. I had to buy back the option. I bought it back at $30. So without fees, I'd be profitable, but because of fees, I'm actually down $11. So I lost money on that trade, $11. Luckily, it's only $11. But if I didn't do that, if I didn't buy it back, I would have lost $2 times 100 shares. So I would have lost $200 by being forced to sell Ford shares that I bought at $10.95, being forced to sell it at $8.50. So the mistake I made is, of course, choosing a strike price that I wasn't comfortable selling at. But of course, the reason I chose this strike price is because the option premium was the only one that made sense. If I chose a $9 or a $10 strike price, the option premium would have been too low, wouldn't have been worth selling. But if I had chosen a $9 strike price, the option premium would have been probably worth, I don't know, 25 cents. Minus fees, I'm left with $14. But a $9 strike price would have been fine in this case because Ford closed, I believe, at 8.7 or 8.8 on Friday. So I would have been under the strike price of $9 and I wouldn't have had to buy back the option or fear of losing my shares at the strike price chosen. So that's the annoying part of covered calls is you really have to choose the right strike price, because you have to choose the strike price that you're comfortable selling your shares at. So I bought Ford shares initially at $10.95. Back then I wasn't selling covered calls, but obviously when the stock dropped, if I want to continue selling covered calls, I have to choose a strike price that's in the money, a strike price that's lower than my initial purchase price, or else the call premium is going to be too low. But I think the right thing I should have done is not sold covered calls on it. Just accept that I bought it at the wrong time, at the wrong price, and I just have to be happy with the 7% dividends that I'd be collecting from Ford and just wait as long as I have to for the stock to come back up. But what I also did 2 weeks ago is I bought more Ford shares at $7.82. And on that, I sold covered calls at a strike price of $8. I sold it at 30 cents, which is pretty weak. So $30 minus fees, I'm left with $19. So $19 on $782 investment is 2.4% per month times 12. That's 29% per year. So percentage-wise, it's great, but obviously because the dollar value is not big, so it seems small, it seems not worth it. So in that case, if my shares get called away, these options expire January 25th. So in 2 weeks, if Ford is trading above $8, my shares that I bought at $7.82 will get sold at $8 if I do nothing. I'll keep the $19 that I collected from the covered call, but I will lose Ford at $8. But this is a really bad trade because Ford is trading right now at 8.8 or something. So it might be best for me to buy back the option. This option here that I sold at 30 cents, it might be best for me to buy it back and then sell Ford shares on the market normally. So either I should have bought more shares or picked a better call option to sell, because obviously $30 is not worth it after fees, or maybe even chosen a better strike price, a strike price that's far from my purchase price of $7.82. Maybe should have chosen a $9 strike price, so if it does get called away, I make an okay profit. But Ford options aren't selling too high, so it was hard to find a decent call premium to sell. If I had chosen a $9 strike price at the time I bought the shares at $7.82, call premiums of course would have been much lower. So I would have needed to choose a longer period, so maybe 2 months. So what I'm going to do now is I'll wait till January 25th to see what happens with Ford. I have 100 shares already from a Ford at $10.95, and I have another 100 shares at $7.82. So I'm gonna wait and combine them. I'll sell covered calls again, but after these ones expire, so that I can sell 2 call options instead of 1 call option. So the fees will be better. So instead of paying $11 every time, so $22 of fees, I'll be paying $12 once. And it'll make a difference because the call premium is so low. As you can see, $30 minus $12 is better than $30 minus $22, of course. Yeah, so that's the mistake I made, is not choosing the right strike price and being greedy, of course. Going back, I probably shouldn't have even sold any on the shares that I bought at $10.95 because they were too far. And for these ones that I bought at $7.82, I think it was okay to sell covered calls against them, but either buy more shares or maybe choose a higher strike price, or even choose further expiry date so that the call premiums are a little bit higher. So for this trade here, if my shares get called away January 25th, I'm going to get 8 minus 7.82 plus the 30 cents that I already collected, right? Times 100. So that's a $48 profit. But from that, I'm going to remove $5 fees for buying Ford. I'm going to remove $11 fees for selling the call option. And I'm going to remove $25 for getting my shares called away automatically, which is called option assignment. So I'm going to be left with a $7 profit on a $782 investment. So definitely not worth it, not worth the hassle. So yeah, this is definitely a bad trade for several reasons. Either the strike price, either the number of shares, should have bought more shares because of the fees, or should have chosen a strike price that's high, a little bit higher than $7.82, at least, so that if my shares get called away, I'm making an okay profit. Or could have chosen an expiry date that is further than January 25th, so that the call premium is higher. So my options really aren't much. I could either just let this happen, lose my shares at $8. Wouldn't be at a loss. I wouldn't be at a profit either, only $7, so really not worth it. But it'll be a lesson learned. Or I can buy back the option come January 25th. I can buy back the option regardless of the price. Obviously, it won't be at 30 cents anymore. It won't be at 30 cents anymore because Ford market price is trading at 8.7. I think right now it's already at $1.30. You see, so right now it's trading at 92 cents. I bought it at 30. I sold it for 30 cents, collected 32 cents, collected 30 cents, but right now it's trading at 92 cents. So if I wanted to buy back the option and close the position, so I'm not in a position where I have the risk of losing my shares at $8, I'd have to pay 92 cents per share. So I collected $30, I'd have to pay $92 just to close it. But depending on the price of Ford, I'd be better off doing that, so that I can sell Ford at $8.90 while I bought it at $7.82. So in theory, this would be the right strategy, but because it's a small amount, dollar-wise, it's not worth it. But if it were a bigger amount, that would be the right strategy. But I'm going to wait till January 25th, see where Ford is trading at. Ford might drop on the last week, might drop below $8, might get close to $8. If it gets close to $8, instead of buying it back at 92 cents, it might be worth 20 cents or 15 cents. So in general, I want to keep the shares because I want to sell covered calls every month, and I want to keep forward until it reaches $11 or $12, and I want to collect the dividends, of course. So ideally, I'd rather keep the shares, but of course, if I have to pay a ridiculous amount to buy back the option, then I'll just get rid of it, and it'll be a lesson learned, and next time just be careful with my strike price. For example, here AltaGas, I bought 100 shares at $14.50, but when I sold the call option, I sold the $16 strike price. So I bought it at $14.50, but I chose a $16 strike price. So I was able to collect $35. Also not a lot, but because I chose a $16 strike price, if I had chosen a $14 or $15 strike price, this $35 here would be more, but I would have the risk of losing my shares at the strike price that I chose. So that's why I chose a $16 strike price, so that in case my shares do get called away, then at least I would have made the difference. 16 minus 14.50, I would have made a $1.50 profit per share. And for that to happen by January 18th, so by next Friday, AltaGas needs to be trading above $16. So most likely that's not going to happen. It's trading at 14 something right now. So I get to keep the $35 and I get to keep the shares, and I can repeat the process. And that comes out to 35 minus $11 fees divided by the $14.50 investment. So 35 minus the $11 fees divided by the $14.50 investment. So that's 1.6% in 1 month divided by times 12. So that's about 20% per year. So if I'm able to do this every month for a whole year, I'd be collecting 20% a year on top of the dividends that AltaGas pays. But hopefully while always choosing a strike price that is above my purchase price, so that in case my shares get called away, I wouldn't be losing money on selling the shares. Now, what happens if AltaGas drops to $12? Obviously, I won't be able to choose a strike price of 16 because the call premiums will be too low. So that's where the problem comes in. I'll have to choose a strike price that's probably lower than my purchase price and hope that by expiry date, AltaGas does not go over that strike price. But you can't really keep doing that because sometimes it'll work, but sometimes it won't. And if you do that, you have to be prepared that you might have to buy back the call option that you sold if you want to keep the shares. But if you buy back the call option that you sold, as soon as you buy back, you can sell it again for the next month. So basically, you're rolling over the call option. You're giving yourself an extra 30 days. So it might sound a little confusing, but it's a strategy I definitely want to implement because just November and December of last year alone, I collected $1,200 from selling call options. So it's something that's definitely worth pursuing, but it does require some tweaking because there's different scenarios that could occur. So you really need to be ready for every scenario. So for example, on Friday, I bought Macy's at $25.82. So 100 shares of Macy's at $25.82. And then I sold the February 15 call option, strike price 27. So I chose a strike price that is above my purchase price of $25.82. So 27 versus 25.82. So if at expiry date, if at February 15, Macy's is trading at 27.01, my shares will get called away at 27 divided by my 25.82. So that's a 4.5% in 1 month if that happens. But I also sold, because I sold the call option, I collected $86. So 86 minus $11 fees, 75 divided by my 25.82 investment. That's 2.9% in 1 month times 12. If I'm able to do this every month, that's 34% in 1 year. So now same thing could happen. If Macy's goes above 27 on February 15, I'll keep the $86 and I'll make a small profit by selling the shares. If it stays below 27, great. I keep the shares, I keep the call premiums. But the problem is if it goes way lower than 25.82, if it goes lower than my purchase price, then I can no longer choose a $27 strike price. I'll have to choose a lower strike price in order to collect a decent call premium. Or I don't have to sell call option, but then I wouldn't be generating that income that I want. Or I can take a $27 strike price, but choose a longer period, a period longer than 1 month. So Another strategy I was considering is buying a 1 year, is selling a 1 year call option. So in the example of Macy's, which I bought at 25.82, I could have gone ahead and sold the 1 year call option. So instead of selling the 1 month, which expired in February 15, could have chosen a January 17, 2020 expiry date. In that case, I would have chosen a $27 strike price. Then I would have sold it at $3.50. So 3.5 times 100 is $350 minus $11 fees. So I would have collected right now $339. That would be deposited immediately in my trading account if I did that. Now $339 divided by 2582 investment is 13%. So I could have collected 13% right now. Already my goal is to make between 10 and 20% per year return consistently. So if I apply the strategy of selling the 1 year call option, could have bought Macy's at 25.82, sold the 1 year call option, collected 13% upfront right now, but then obviously that means that I'd be holding the stock for a whole year. While holding the stock for a whole year, I'd be collecting 4% dividends. So I would add to that 4%. So now I'm at 17% in 1 year with Macy's. And most likely after a year, Macy's will probably be trading above 26 or 27. So if that's the case, I'm going to collect an extra $1.18 by selling the shares at $27. So I've collected 3.49 from the call option plus $1.18 from selling the shares after a year times 100 divided by the 2582. So that's 18% plus another 4% from dividends in 1 year. So in 1 year, I would make 22% return with this investment. And I would have collected 13% upfront at the beginning of the year that I could use to buy something else. Now imagine if the dollar amount was high, you could actually sell a call option, collect it. If you receive $1,000, you'll buy another stock that you could probably buy 100 shares of, sell the call option again of that other stock. So you just keep collecting call options until you can't anymore. So that's really the true effect of compounding, and you're getting it upfront. So that was another strategy I was considering. But of course, it would mean that I would have to keep the shares for a whole year, but I would collect 13% upfront. I'd collect 4% dividends in the year, and then depending on what Macy's is trading at in a year, but most likely in a year it's going to recover. I don't think it's going to continue to drop. It's already near a 52-week low. So most likely in a year it goes back up to 30. That doesn't concern me because I would have to get rid of it at 27. So I'd make a 22% return on Macy's in 1 year. But the reason I didn't do that, because I'm in my margin account and this is borrowed money, I'd have to be paying 8 or 9% interest per year. So from the 22%, I'd remove 9% right away of interest because I'm in my margin account. If I were in a different account that is not using borrowed money, then I would have probably done it. So in this case, I just sold the 1 month call option so that if I can repeat it every month, I'd be making 30% per year, which is on top of the 4% dividends if I keep the shares, and on top of any capital gain I can make from selling the shares. So I felt like there was more flexibility with the monthly call option, but a yearly call option is definitely going to be less of a headache. You do it once at the beginning, and you just don't care what happens in the middle. You already collected your 13% upfront, which you can use to buy more stocks. And since my goal is to make between 10 and 20% every year consistently, I think this would be the perfect strategy for me to sell a 1 year call option. But I'm not going to do it in the margin account. So yeah, that's what I wanted to talk about in this video. So if you have any questions, leave them in the comments below. Let me know what you think about this covered call strategy, if it's worth the headache. As always, if you're going to open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get between $25 and $250 back, depending on your deposit. Also, check out the links in the description below the video to help support the channel. Thanks for watching.